Welcome to this week's episode of The Big Conversation from Singapore. The recent FOMC meeting has been one of the most anticipated events in the last few years, as market participants look for clues on how aggressive the monetary tightening could be for 2022 to tackle the stubbornly high inflation numbers seen in the last 6 months. This potential change in the Fed's stance has resulted in an increase in volatility in all financial assets, as investors ask questions about how to protect their portfolios for 2022. The S&P 500 has retreated by 5% and the Nasdaq by 9% in just over a month. Could this be the year where Asia and emerging markets outperforms? Brazil has seen a near 12% rise year to date, with Hong Kong and South Africa also a beneficiary of some positive flows, with an increase of 5% year to date. With me this week to make sense of all the recent volatility, I asked Steve Brice, the Chief Investment Officer at Standard Chartered Wealth Division, for his thoughts on the markets. We also look at how emerging markets, and Asia in particular, deal with the inflationary headwinds and whether the current valuations are attractive enough to sustain a period of outperformance for the rest of the year. Steve, thank you very much for coming on to the big conversation.
It's a pleasure.
Hosting this one in Asia. Thanks very much. So the last time we spoke, a lot have changed since then. We talked about reflation trade, but as you know, the FOMC meeting last week really has changed a lot. So just very, very interested to see what your views are, house views in terms of number of interest rates and how you see that trajectory of interest rate changes going ahead.
Yeah, so I think from our perspective, we still think the market is overpricing the scale of interest rates. Obviously, interest rate hikes, the market's looking at over 5 now for the course of the year, so over 125 basis points. We think we're going to get 75 basis points, which is obviously quite an out of consensus call at the moment. The main reason for that is, yes, we've got clearly strong pressures at the moment building for higher interest rates. So inflation is still very high. We're likely to see even higher this week. The labour market is still tight. We do believe that we're going to see more and more people coming back into the labour market. Actually, the latest employment report suggested that's coming already. And that will lead to lower inflationary pressures from the labour market. Supply side constraints will ease as well. So growth will slow, inflation will slow as we go through this year. So yes, if you straight line from where we are today, they're going to hike a lot. But given those variables, we think they're actually going to back off at some point later in the year. So 25 in March and then another 50 over the course of the year.
That's interesting. Can we just zone in a little bit in Asia? I mean, we're also seeing inflationary pressures here as well. I mean, how do you see the central banks perhaps in Asia dealing with this, or are they dancing to the tune of the Fed?
Well, it really depends on which countries you're looking at. I think obviously the most important for us would be China, and they're dancing to a very different tune, right? So firstly, the currency's been under appreciation pressures. So we're seeing that coming through. So they're easing monetary policy as the rest of the world is thinking about tightening. So from that perspective, we're not seeing too much pressure. For the rest of the region, probably what's going to be really important is what happens to the dollar. So if the dollar continues to appreciate, which obviously it has done over the course of the last 3-5 months, if that was to continue, that would put pressure on other countries, particularly the more with higher external debt levels, to increase interest rates to sort of just protect their currencies somewhat. But we actually think that the dollar is probably in some form of peaking here. So we think those are probably going to be very short-lived. So later in the year, that's probably going to allow countries to focus more on the domestic economy. I suppose the exception to that would be India, where we do expect rate hikes to come through.
Talking about a domestic economy, maybe we can touch on China a little bit. I mean, there has been some talk that the PBOC cutting rates is a sign that the economy is in trouble, or are you feeling that perhaps they're just giving a little bit more of a nudge to keep growth going? Certainly, China has underperformed immensely, as you know, especially the last couple of years. Is this the time to look at China right now?
So from a macro perspective, obviously, we already know the economy has slowed dramatically. So it was the first out of COVID, but now the zero tolerance for COVID is really hurting them in terms of a growth perspective, and that has obviously global potential from problems from a supply chain perspective as well. So the easing in policy that we're seeing is likely to be just to try and moderate that slowdown. I don't think they're really looking for a V shape economic recovery, but they are obviously looking to mitigate some of the short-term challenges faced by the economy, so by injecting liquidity. In terms of equity markets, we're have a core holding or neutral view on China, so we expect it to perform broadly in line with global equities. We're bullish on global equities, so that's not necessarily a bad thing, but we don't think everything's in place yet to seek or lead to outperformance of the China stock market. So I think we'd need to see significant more in terms of policy easing, both on the monetary front and the fiscal front, and a bottoming of growth expectations for that to come through. So we don't believe we're at that point yet, but obviously we're watching it very closely.
I mean, certainly the narrative is still pretty negative with the whole common prosperity theme very much rife in China. We've had some big moves, as you know, so-called crackdown on technology companies, property companies especially. Are these signs that perhaps we're beginning to see a recovery in the markets? It's a little bit more balanced now, I would say. I mean, is that a good sign?
Yeah, certainly if you look at investor positioning, actually people are still underweight Chinese equities. I mean, they have been pretty much all the way through, right? So especially international investors. So we've seen a significant shakeout in the market, and that could lead to some people sort of saying, okay, actually maybe the environment's going to get better. We certainly think we've seen sort of peak regulatory pressures, etc., coming through on different sectors such as the tech sector, education sector as well. It was difficult to get more severe than the education sector, of course. But I think we do see that we see that having peaked. So ultimately, I think the authorities are getting more sensitive to the market's outlook. Again, that's probably allowing us to form a bottom, but it doesn't mean that we will outperform. It just means that maybe we'll just trundle along in line with what's happening elsewhere in the world.
Property bonds, high yield bonds especially, very, very popular here in Asia among the private banks. You're in the sort of heart of it, as it were. I mean, what would you be telling your clients now? I mean, you're looking at yields sometimes 10, 11, 12%. Is that a scary thing, or is this an absolute bargain? So just interested to get Standard Chartered's views right now.
As an asset class level, Asian high yield or China high yield or property high yield is extremely attractive. So we see it as a huge opportunity for investors. Obviously, you need to be selective, right? So you can argue what selective means. Does that mean bonds that are already pricing in pretty much full-blown default and therefore trying to predict what recovery rates are going to be? That would obviously be the more speculative end, but we would be saying, this asset class at the yields on offer in a still yield-starved world. Obviously, global yields have gone up, but nowhere near the rates we're talking in Asian high yield. So we do believe that's probably one of the safest, inverted commas, options out there for a long-term investor. As always, the path to those returns being realized, as we've learned over the last 3 months, is likely to be non-linear. So we're going to see quite a bit of volatility through the process.
So we just take a step back for 2022, reallocation of assets, perhaps out of developed countries to developing countries. A lot of people are looking for homes for big chunks of money. When we're looking at Asia, is this something you're seeing? Does Asia actually provide a platform for people to reallocate money? Or is India really the one where perhaps we're going to see a lot more money coming through because it can actually absorb quite a liquidity?
I think the key thing here is what happens to the dollar. So if we see the dollar peak out, then that leads to a virtuous circle of central banks easing policy, so stronger local growth, exports doing well as well from the global environment. So everything sort of fits into the narrative of emerging markets generally outperforming relative to developed markets. We're just not there yet. So we've had a big move. So, I mean, if you look at we obviously believe in peak Fed, right, in terms of the market's overpricing. We haven't had the European angle coming in. We're starting to see signs that might be coming into play. So if we see the dollar breaking below 94.50 on the dollar index, or the euro level is around 115.25, I think that could be a really important signal that the dollar is peaking and has peaked, and that could be very good for emerging markets. In terms of different areas that we like, we generally still like tech in the developed world. So US, obviously, we've seen a big sell-off in the NASDAQ, which is not, people think NASDAQ is tech. It's actually not one for one, of course. You've got many consumer discretionary and communication services names in there that a lot of people have focused on recently. But we do still like tech in both the US and in Europe. Very different profile. Europe, is more hard tech, semiconductors and the like. So that's really where we're placing a bet. Also, we like financials in Europe. So that's another place, obviously based on the change in the European Central Bank stance with regards to policy rate hikes that should support the banks. And we're already seeing that coming through, of course.
I just want to touch a little bit on commodities and specifically oil, which has been very much the headline recently. In fact, Malaysia and Indonesia, I believe, are beneficiaries of a strong oil price. Do you guys believe in that view as well? And is that going to trickle down perhaps into a much stronger position for Malaysia and Indonesia especially?
So obviously oil prices have been tracking higher, and we expect them to continue to do so fairly gradually. So nothing like we've seen obviously over what we saw in 2020 after the negative number we saw on an oil price and then the recovery thereafter. But we do see oil prices going modestly higher over time. That's supportive obviously of the oil producers. So Indonesia is a bit, pros and cons of higher oil price. Actually, it's not as open, but yeah, so that should provide some sort of support. But the challenge for these markets generally, and you alluded it to before, if you look at it, you sort of go, okay, China's quite a deep market. India's quite a deep market. Outside of that, and Korea's a big market, but fairly concentrated. You get down past Taiwan and then you start again quite small markets. So attracting huge amounts of inflows of capitals, that small amounts can make a difference, but you're probably not going to get the huge wave that you would get to other bigger markets.
Yeah. So the other sort of asset class which hasn't really performed that well has been gold. And certainly I was reading some of your reports, you as a house are quite bullish on gold. Could you give us an idea about that? Because you alluded that maybe inflation wouldn't be a big problem, but it can be seen as an inflation hedge. But can we unpack that a little bit?
So I think on the short term, obviously inflation is still biased to the upside. So the risks are still there, right? So from that perspective, and to the extent that we see equity market volatility coming through from that can be a hedge for you. So that's why we sort of have around a 7% allocation of gold in our asset allocation models at the moment. It's really say, look, there is this inflation risk and we have this volatility. We expect equity market volatility to remain relatively high through to the end of the cycle, which we still think is probably 2 years away at least. Over the longer term, as I say, if we do see that dollar crack, if we do see us going below that 94.50 for the dollar index, then I think that should be a positive factor for gold as well. So yes, we think gold's going higher, but it's as much the portfolio diverse for aspects that we like it for.
So I suppose stay invested would be the message to your clients.
So yeah, so actually the way we're positioning this is that we believe that the sell-off we've seen recently is a window of opportunity for investors. I know a lot of people are very worried about higher inflation, higher interest rates, but as I say, we think most of that is already priced in, and therefore there's probably going to be some good news going forward. And even if you believe, as we do, that inflation is going to remain relatively elevated, yes, coming down, but we don't think it's going below 2% this year, right? So it's going to be in the 3 to 4% bucket probably by the end of the year. You should be looking at assets that can generate that sort of return. And if you look at the long-term 7-year capital market assumptions we have, you really have to take equity exposure or exposure to private assets to generate a yield that's in excess of that inflation rate. So I think that's the way we're positioning. A lot of people are saying inflation makes me scared to invest, but actually inflation makes it more imperative that you invest through the volatility.
Yeah. And, the other problem here has been, sort of differences in COVID measures in different countries. And this is a big supply part of the economy here. So perhaps maybe as COVID improves, we will see that the pressure coming off in terms of supply side. That obviously will improve inflationary measures. I mean, is that something you think that could happen? Yeah,
so I think that's true for most of Asia. We feel it here in Singapore, right? You can see that, yes, we're seeing a spike coming through, but you can see we're still opening up, obviously fairly cautiously, but still trying to open up. But what matters to the supply chain is China, right? So one of the big questions actually for us to answer is China deflationary or is it inflationary? Obviously, slower growth is deflationary, but the zero COVID stance is inflationary because it gets in the way of those supply chains. So how that evolves as we go through the year is going to be really important for the long-term inflation, or for the inflation picture across the world.
That's fantastic. Steve, but thank you so much for your time. Lots of things to talk about, but let's hope for a much better 2022. Thank you.
Absolutely.
Thanks
so
a
much,
lot.
Garett.